we are going to have a short prayer, thanking the Almighty for this day. Dear God, please thank you for giving us an opportunity to join this meeting. Thank you for everyone's life that is here today. Thank you for protecting us through the past year, which has been quite difficult for everyone. And as we go into this meeting, Lord, please give us a chance and an opportunity to digest each and everything that has been prepared by our presenters. And I pray all this in the mighty name of Jesus Christ. Amen. Before I continue, can I confirm from my colleagues if they can hear me, please? Mr. Ankit and Stuart, please.
Yes, we do.
Okay. Thank you very much, Mr. Neil. Without further ado, as I earlier stated, this webinar has been prepared by Grant Thornton. As always, when many of you are clients, our colleagues, our prospective clients, when you brought your business to our firm, we promised one of the things among the different services we give, one of the major ones is also tax, which we told you that we shall always cater for your tax needs. We shall keep you updated about any changes, about any amendments that have to be made and all the different things. So once again, today, as we're here, that is what we are going to do. But before we continue, there are a few house rules that have been displayed. For those who are already on this meeting, please read through those house rules. Make sure that your microphone is muted. Make sure that your camera is off. Make sure that you do not press the request control button. And to get the best experience and quality audio, please use external headsets. Furthermore, if you have any questions, they will be addressed at the end of the presentation. But in the meantime, post them in the chat box. Someone will respond to you there, and then if it needs audio response, we shall respond to them at the end of this presentation. So thank you very much. So far, our meeting has about 30 people. We are going to start it, and more people will join us as we continue. So first, we are going to have some opening remarks from our managing partner at Grant Thornton, Mr. Anil Patel. He is also the director of the tax department. He came to Uganda with a vision, with a dream, and brought his experience from India, and now he has over 20 years of experience in the industry of audit, tax, and advisory. He has nurtured this firm, he has grown it. He is also a chartered accountant, both from India and in Uganda, and a member of the President and Investors Roundtable. With over these 20 years of experience, he has worked on many statutory audits, many public sector audits, transaction advisory, different aspects of the tax issues with custom audits, with opinions, with exemptions. Some of you have even interacted with him personally, others over email. So Mr. Neil, please give us some opening remarks to our dear listeners.
Thank you very much, Chelsea. Thank you. Dear clients, our associates, friends, and everyone who has joined this webinar, I want to wish you well. Let me start by thanking you, first of all, because learning is never easy. Thank you for spending time, actually taking time out to attend this important webinar. I know each year when February ends or somewhere in March, most of our clients, yourselves, you wonder what new changes, new amendments are going to come in the budget. Normally we use the word budget, and what will happen to your business. Particularly last couple of years, we have been facing pandemic, and that has severely impacted most of your businesses. And now you are trying to recover the business. You're trying to survive, many of you, and trying to make it more sustainable as the time comes. So with that, you always expect what is government going to give to you by way of tax policy amendments, so that your business environment can become better. The potential to grow business and manage business becomes better is something that businessman always wishes. So as you are aware, Ministry of Finance, Planning and Economic Development on behalf of the government has published 22-23 tax bills, and you must have received copies of them by way of public means or by WhatsApp or by emails. We don't just hurry unnecessary in forwarding those bills as they have been received, because it's technical in its nature and might cause confusion in your minds, and you might be excited for no reason. So we always take our time to analyze them. As you know, every year our tax team sit down, they give, including spending weekends, to analyze them, to understand the intention of the government's in making that amendment. What's the intention behind it? What will it impact? And as you know, the taxes are hardly straightforward. Even for us, it needs to be understood. We need to, interpret them. Sometimes it may have multiple interpretation. And if we give you haphazard, or if we give you any interpretation in hurry, that might also create a confusion among yourselves. Though we sit down, we take a time, we consult internally as well as externally before we come out and arrange such webinar, or before we give you our publication on the interpretation of the amendments. So at this juncture, I would also like to share with you how Grant Thornton plays a vital role in whole process of the tax amendments. Now, we generally listen to your problems by virtue of our interaction with you in all the departments, whether it is audit, tax, advisory, or simply you come and incorporate a company with us. But in all such situation, we keep our ears and eyes open. We understand your business challenges. We understand your frustrations. We understand the obstacles that you face as a result of particular tax policy or the way it is implemented ununiformly. We also analyze the general business situation in our country compared with the East Africa and our, because we have a presence in East Africa, we also analyze the business environment there and the policies in other countries. We also, among ourselves with our teams between audit, tax and advisory, we also consult each other as to what should better policy look like and what amendments we need to propose. And then we take it up this matter formally with Uganda revenue authorities. We ask for their appointment. We go and we present them, as well as we go to Ministry of Finance. We make a presentation, and basically we take your such issues with the Ministry of Finance. So we are happy to inform you that in this year's amendments that you are going to hear in few minutes from now, there are many changes that we proposed to Ministry of Finance and URA have been considered, and we are very happy to say that. Particularly, you will see in Section 21, the exemptions, Section 85, withholding tax on inbound transport charges, under Section 118, withholding tax on purchase of assets, and rental tax, that where there are various changes in the past couple of years you see. So that's where we made a proposals, and they have been accepted for betterment. While some of them have not gone through, but we have not left them. We have not given up. We are still pursuing them through Uganda Manufacturers Association and other means, such as amendment in Section 40C and Section 38(2) that we proposed, that significantly impacts your ledger account balances that you see it, and most of you must be receiving the reminders, first, second and third reminders. So we propose those amendments so that the ledger accounts can be cleaned, and URA also can focus in constructive tax collection demands over so-called demand from ledger accounts. But we haven't been successful there. We will continue to pursue it there. The bills do not seem to introduce new tax measures, but rather appear to be cleaning the act, clarifying or correct ineffective or poorly drafted provisions in the previous years for efficient tax collection. The tax measure also coming on the heels of promise by the government that post-COVID, no new tax measures, at least for the revenue enhancement, would be introduced. So that promise, I think you will be able to see. As part of the cleaning up exercise, government is repealing a number of provisions under various finance acts, as our presenters will soon elaborate on them. The act shall become effective from 1st July 22 after they have been scrutinized by the relevant committees of the parliament, passed and assented by the president of our country. In accordance with the Public Finance Management Act, the processing of the bills must be completed by 31st May 2022. With these few remarks, let me wish you a great deliberation during the presentation, and I'm sure you will be better informed at the end of this webinar. Should you have questions, obviously you can put them in chat box. We'll try to respond. But if you cannot by any reasons, because let me tell you that some of the clarification, even we might have to consult further. But we will certainly come back to you. You can also send us an email. Chelsea will send our general email where you can send and you can ask your questions. But also there will be a dialogue, open question answer session at the end of this webinar. I thank you so much. Let me hand over back to Chelsea. Thank you.
Okay, thank you very much, Mr. Anil. It is always a joy to listen to our managing partner. He always has so much insightful words to give, so much good knowledge to impact in us. So as he stated, our next presenters, there are going to be two of them, Mr. Ankit Jangla and Mr. Mlavi Stewart. These two people have specifically been mentored by Mr. Anil himself in Grant Thornton. They have grown in this industry of tax consultancy services. They have become members of Grant Thornton. And the first presenter is going to be Mr. Ankit Jangla. He is going to take us through income tax. Now, Mr. Ankit is a qualified chartered accountant from India and also a manager in the tax department here at Grant Thornton. He has over 10 years of experience, 7 of which have been in Uganda and specifically tax consultancy. His portfolio is very big. Very many of you have encountered him on tax audits, on tax opinions, on tax exemptions, and various other tax services that you have come to Grant Thornton to consult with us. I'm sure you've had very good experiences with them. So he has analyzed for us the proposed amendments in regards to income tax. He has prepared a presentation. He's going to give us a digest, the ins and out of what the bill proposes, how it might affect your business if it comes into pass, and all the other things. So I'm going to hand over to Mr. Ankit right now so that he can start his presentation.
Thank you, Chelsea. Chelsea, if you can confirm that I am audible.
Yes, you are audible enough.
Okay. Thank you, Chelsea. Good morning, everybody, and thank you, Mr. Anil, for the insights and brief onto what is expected to come in our presentation. So without wasting much of the times for the members present over here, I'll start with the proposed amendments in the Income Tax Act. So very first amendment, like every year, Section 2. What is Section 2 to Income Tax Act? Section 2 elaborates the definitions of various terms which are used in the various parts of the Income Tax Act. So in that breath, beneficial owner definition is proposed to be going through some changes. Beneficial owner definition was tweaked in the last year act, and it is further proposed to be tweaked in the current year 2022-2023. The overall or the entire objective of the government or the authorities is to lift the corporate veil and reach the ultimate person who is beneficiary to the transaction. Also, the amendment is in line with the definition of beneficial owner, which is being adopted by various other countries or the various other tax jurisdictions. Another significant point to the definition of beneficial owner is it enables the revenue authority to share the information with other countries or other tax jurisdictions wherever the need might be, or receive the information wherever the need arises. So the beneficial owner definition has undergone these changes. Another important point to note over here in the beneficial owner definition is that now it might not be possible to take the advantages of the rates mentioned in double taxation avoidance agreements when the beneficiaries or are not the original residents of the countries with whom Uganda has entered into DTAA. So supposingly over here, if I can elaborate myself, say Uganda has a DTAA with Mauritius. Now, if there is a transaction with the company in Mauritius and the shareholders of that company are not the individuals or are individuals who are not the original residents of Mauritius, the treaty benefits may not become available. There is further clarification which Uganda Revenue Authority might come out with, but these are some insights which we thought may have, or these are some impacts which we thought may have by virtue of this amendment in beneficial owner. We move on to the next definition, which is the definition of an exempt organization. If all of us remember, exempt organization definition underwent change in the last year. So what was that change? That change was a very positive change to introduce the words not for profit in the definition of the exempt organization. So over here, there has been further new amendment or further new proposed amendment that the words to be introduced are another kind of an institution, which is a research institution, meaning which a research institution whose object is not for profit may also qualify to be entitled for an exemption and get away with payment of corporate taxes. So, but just for the benefit of members, this exemption needs to be operationalized because the powers to grant or examine or scrutinize the exemptions are with Commissioner, and we can definitely elaborate this process as and when the time comes or at the specific request. Moving on to another set of amendment. Now this amendment has a large impact. It cuts across the sectors of economy. The amendment is in relation to rental taxes. So what is this amendment? Again, last year there was amendment to the mode of calculations for rental taxes, both for individuals and corporates, which led to ambiguities, or there were which led to contradictory positions being adopted by revenue authorities and taxpayers. So, now to clean up that ambiguities which were created in the previous law, the minister has proposed following amendments. So the individual rental income earners will be available or will have to discharge their rental tax obligation straight at the rate of 12% on the gross rental income received. For a non-individuals, meaning a company kind of an organization, the expenditures or the losses would be capped at 50% of the rental income, and balance unutilized expenses or losses would be allowed to be carried forward to subsequent years. So with this amendment, there has been a lot of clarification. One more clarification I want to add over here is the interest expense which was available or which is available to an individual taxpayers or on the mortgage loan interest which is paid and which is allowed as a deduction is now proposed to be scrapped. So the direction adopted by the minister and ultimately the policy makers is towards the simplifying of rental tax regime, easing the burden of compliances and yet making the effective tax collections. So this is the summary of rental tax amendments proposed for FY 22-23. We move forward to next set of amendments. They are amendments to section 21. Now what is section 21? Section 21 is a whole section which by virtue of which exemptions are granted to various forms of income or various institutions, various organizations. As has been a pattern from last 3 odd years, even that pattern is continued in current year. The section 21, there has been some clarifications, some modifications, which I'll be able to take you through as we go forward with this part of presentation. So very first amendment is made to an income of a Bujagali hydropower project. Currently, Bujagali hydropower project income is exempt till 30th June 2022. This is now proposed to be extended to 30th June 2027. This might have been proposed with a viewpoint of minimizing the electricity cost for the consumers in a country. Moving on, there qualifying income. See, currently, or there is a formula which has been prescribed under section 21. As you are very well aware, there are exemptions available to the industries in strategic sector. Now, to compute the amount of exemption, there is a formula which has been prescribed in section 21, paragraph 1b. Now, there was some confusion or lack of clarity through which some portion of the formula was not been applied in proper spirit. Now, to eliminate that ambiguity, the proposed amendment seeks to clarify that the amount of investment which has to be considered for purpose of calculating exempt income must be the cumulative investment or the investment which have been made from commencement of the tax incentives or commencement of the tax exemption as granted by the Act. So it always was supposed to be that way, but over here the language or the wordings of section were not giving that message, which has now been provided or proposed to be provided. Further, there over and above the strategic sectors which are laid down and the qualifying criteria is laid down for the strategic sectors like say agro-processing, information technology, etc. There is a blanket exemption which is proposed to be introduced. And what is that exemption? That exemption is now provided in subsection AI for a business or the manufacturer who invests 35 or proposed to invest, has a capacity to invest 35 million US dollars over a period of 10 years for a foreigner and 5 million US dollars in case of citizen. Obviously, there are some conditions tied up like the raw material requirement to be locally sourced and employing the citizens. I need not go into the definition of foreigner or a citizen because it has been amply clarified by virtue of the definitions of both these terms by the previous amendment to the law. Another exemption is proposed to be granted to an hospital facility developer. So An hospital facility developer, irrespective of him or her being a citizen or foreigner, is entitled to an exemption for a period of 10 years if the investment capital is 5 million United States dollar. Over here, there seems to be some ambiguity and a clarification is required of what will happen to an existing hospital facility developer. But such kind of clarifications are expected to come going forward in the future when laws are implemented. And we at Grant Thornton will continue to pursue, as Mr. Anil told, various stakeholders for the clarification for benefits of the society or members at large. We move forward to next amendment. Amendment to section 85. So what is section 85? Section 83 to section 88, take your pardon. Section 83 to section 88 mentions the source rules wherein the income is termed to be source in Uganda and has to be taxed in Uganda if it meets the certain criteria or conditions mentioned thereupon. Now, amendment to section 85 is a very welcome amendment, and it will cheer up almost all the sectors of an economy, may it be an importer, trader, manufacturer, because all of us experience this kind of a transactions in our business, in everyday's business, day-to-day business. Now, what is this amendment? This amendment seeks to clarify that whenever there is a cargo or a passenger service which has embarked from outside Uganda, means the journey has started from outside Uganda and that service is provided by a non-resident transporter, no withholding tax is required to be deducted. Why no withholding tax? Because by virtue of this proposed amendment, this income of a non-resident is kept outside the ambit of Ugandan income tax. So another question, what happens if the cargo or a passenger service has embarked from Uganda? Means the journey has started from Uganda. Now, in that case, when a journey starts from Uganda and the service provider is a non-resident transporter, 2% withholding tax is required to be deducted. This is a welcome amendment or proposal. Why? Because in past 2 years, there has been lots of controversy and Revenue Authority has in some instances charged 15% in cases where cargoes have embarked from outside Uganda. But we have been challenging this position of Revenue Authority, but that position of Revenue Authority received some kind of a mileage in the by virtue of judgment of Tax Appeals Tribunal in Roche Limited versus Uganda Revenue Authority. But with this proposed amendment, all these ambiguities are expected to go away. We move on to next set of amendments. If I can summarize the next set of amendments, they are into the amendments in petroleum and mining operations. So the very first amendment is amendment to section 89 GB. Again, this is a clarificatory amendment which states that petroleum exploration expenditure for a licensee is to be amortized 100% in the year in which it is incurred. So 100% expenditure available in the year of expenditure. Moving forward, we go on to another set of amendment are the penal provisions for petroleum and mining operations under section 89P and under 89QA. So there has been a modification in due date to pay taxes. Current regime gives 7 days for a payment of taxes after the return is filed. Now that 7 days limit is proposed to be eliminated, and it is proposed to be harmonized like other provisions which are applicable to other taxpayers. So the new deadline for the petroleum and mining operators would be the date on which the return is filed is the due date for payment of taxes, or the date on which assessment is raised is the due date for payment of taxes. Another one, there are specific penalties which are proposed to be introduced for delay in submission of information or delay in submission of specific requested information, and the penalties range from US dollars 50,000 to United States dollar 500,000. So these are huge penalties which have been prescribed, and it has been prescribed with the virtue of clarifying that mining and petroleum operations have specific penalties which overrides or which go in line with over and above the penalties which are mentioned under various sections of Tax Procedures Code Act. We go on to next amendment. This amendment is amendment to section 118B. Again, this is an amendment which cut across to the various sectors, or in fact all the sector or all the businesses. Why? What is currently under section 118B2? Now, as per the current provisions, if there is any purchase of an asset or any purchase of a business asset by a resident from another resident, withholding tax at 6% needs to be deducted. So this withholding tax at 6% needs to be deducted irrespective of the deductor is a withholding tax designated withholding tax agent or not, or the recipient of a payment is withholding tax exempt or not. Now, to liberalize this regime, there are some proposals. So what is that proposal? The definition of business asset is proposed to be amended. So by virtue of this amendment in definition of business asset, they want to clarify that what is business asset. First of all, land will be considered as a business asset. So the first relief is any other asset except land may not be covered under section 118B2. Now, the proposed amendment specifically mentions the word land, but in our understanding and the legal principles which are available, the land goes with the building. So for a land and building, which the WHT is only applicable when the land and building is held by a company, trust, or a partnership. Land and building is not used as a trading stock, and if a land and building is used by an individual and the rental tax is paid on that land and building, again it is out of the ambit of business asset and withholding tax is not applicable. Another one, even if the recipient of a payment is withholding tax exempt, in that case also no WHT deduction is called for. Another condition, wherever land or building is transferred as a gift or by will or by inheritance, and it is not generating any income which is included in the business or employment or property income, then in that circumstance also no withholding tax deduction is called for. So this is a clarificatory and a very welcome amendment which will help to do away with the current ambiguities which are being faced by various taxpayers due to the various interpretations by the different sets of revenue authority. Other amendments are amendments in the income tax schedules. What are these amendments? The one amendment is cutting across for the rental, which I was able to take through while explaining the amendments to the rental provisions, and again want to clarify that 12% corp tax will be applicable for an individual taxpayers who earn the rental income, meaning 12% of gross rental income has to be remitted as corporation tax. Another one is amendment to first schedule. First schedule has exempt organizations being listed under it. So the International Development Law Organization is proposed to be introduced in the list of exempt organizations, and the DFID is to be replaced with Foreign Commonwealth and Development Office, famously known as FCTO. So this takes care of all the proposed amendments under the Income Tax Act. I'll hand over the dais to my colleague Chelsea, who will be in the position to introduce the next presenter, and he will be able to take you through the other amendments in the fiscal laws. Thank you very much, and thank you for patiently giving me an audience. Thank you.
Thank you very much, Ankit. I am sure our listeners have enjoyed that presentation on income tax, especially the landlords we have here, both the individuals and the companies. I'm sure some of them are already smiling and hoping that Parliament says yes to the proposed amendments for the rental tax, among other things which our listeners have also liked. We thank you for that digest. It was very insightful. So please do not hesitate. I'm sure some of you are having questions right now. Post them in the meantime in our chat box. They will be responded to at the end of the session. And if it is a short question, someone will immediately respond to you in the chat box. And so our next speaker is going to be Mr. Mulabi Stewart. As I earlier stated, both our presenters today, Mr. Ankit and Mr. Stewart, have been under the mentorship and training of Grant Thornton for a very long time. Mr. Neil has personally seen to it that they become one of the best tax consultants we have in this country. So Mr. Stewart is not so much different from Mr. Ankit. They've worked together in this company for a very long time, for over 7 years. He has attained his qualifications that have also helped him grow further in these consultancy services. He has gotten a postgraduate diploma from East African School of Taxation. He has got his advanced certificate in international tax from IBFD, which many of you know. And his portfolio is also equally large. He has handled some of your audits, some of your custom audits, some of your exemptions, and numerous other tax consultancy services that you've reached out to him. He is now here to take us through the indirect tax session, where the Minister of Finance has proposed some amendments. He's going to take us through VAT, excise duty, and TPC, and explain to us how these amendments will affect our business if they come into pass, how some of them will be very nice for our businesses. So Stuart, I'm handing over to you. Please take our listeners through the next session.
Okay, thank you, Chelsea. Just confirm if I'm audible.
Yes, you're audible enough.
Okay, thank you very much. A good morning to all our listeners and our viewers. Thank you for taking the time to join us for this proposed amendments debriefing. So I shall be taking you through the indirect taxes and the different proposals which have been tabled by the ministry, and what impacts they could be having on your businesses going forward. Yeah, so let me kickstart with the VAT, the proposals. The first one, it basically seeks to modify the VAT on imported services. So in the previous amendment, last year's amendment, imported services which are used in a provision of exempt supplies were exempted from any VAT on imported services, more commonly known as the reverse charge VAT or the reverse charge mechanism. Okay. So with the current bill or with the current proposal, okay, that benefit which had been accorded to some businesses in the previous year is now sought to be scrapped. So ideally right now, if you do import a service, whether it's being used in providing an exempt supply or not, it would be subject to imported services VAT. A number of reasons for this could be tabled. The most I would say the most rational one being that imported services VAT is made to, it's made to level the playing field between local suppliers and non-resident suppliers. But in case any person or in case any business out there wants us to delve more in this particular provision and its rationale and how it could be impactful on your businesses, please feel free to approach us. We shall be able to give you more in-depth on this particular proposal. So my colleague Ankit talked about some modifications to the first schedule of the Income Tax Act. This hasn't changed much with the VAT Act. The same modifications have come as well under the VAT. Maybe I just want to shed some more light on the Department for International Development with the Foreign Commonwealth and Development Office. Actually, it's not a new organization. It's just that in June of 2020, DFID was morphed into the FCDO. So it's just providing for the new, can I say, the new body which has morphed from DFID to FCDO. So straight to the different schedules of the VAT Act. Let's begin with the first schedule, which provides for exempt supplies. Now, when I talk about supply of menstrual cups, I'm going to marry it with a zero-rated schedule because it has an impact there as well. So the bill seeks to scrap the exemption of menstrual cups under the exempt schedule. And as we go forward, you'll find that it's now being proposed to be included under the zero-rated schedule. So the main, one could ask, what is the reason for this? Just for those out there who may not really understand the implication of this, subject to apportionment and what have you. So it's basically a benefit for businesses engaged in a production and supply of menstrual cups. The next one is an exemption which has been actually in the VAT Act. The current bill just seeks to tweak it or to modify it a bit by removing the criteria of a national referral hospital. So currently, the VAT Act second schedule, which is the exempt schedule, provides for a number of exemptions. I'm talking about supply of services for the feasibility study, design, construction, locally produced materials, and so what have you, for those businesses engaged in development of hospital facilities at the level of national referral hospital. Okay, so the current bill seeks to remove that criteria of national referral hospital. Again, one could ask that why, like, what's the rationale of the lawmakers in bringing about this current proposal? Well, according to us and as per our analysis, right now there are so many private hospital developers who cannot benefit from this same proposal, so from the current exemption, but with the current proposal, it will liberalize these exemptions to also include all the other private hospital developers who are developing hospitals and in the process reducing the cost of healthcare. The other proposal is seeking to scrap the exemption for cotton seed cake. Now, cotton seed cake has always been a subject of an ambiguity. That is it processed? Is it unprocessed? So I think in the past year or two, it was individually put under the exempt schedule as an exempt supply. Though before that, businesses engaged in supplies of cotton seed cake had always been back and forth haggling with URA if their services actually exempt by virtue of being agro-processed processed products or not. So there is some action in the back which we want to get privy to and understand what the rationale is of the Ministry of Finance and URA for removing this particular exemption, and we shall be able to give you more insight and depth of that discussions. And maybe just before proceeding, I just want to mention that whatever we are presenting are just proposals, and they are subject to additional discussions before the final amendments are published, which will be in June at the time of the budget reading. Going on to the second schedule of the VAT Act, as part of the COVID relief bills, which were released in 2020, the government included a number of items under the second schedule as well. One of them was the oxygen cylinders, and the current proposal seeks to tweak the oxygen cylinder provision a bit by also providing for the oxygen for medical use. So the current VAT Act second schedule only contains oxygen cylinders, but if passed into law with the current bill, it would contain both the oxygen cylinders and oxygen for the medical use. I think most of us saw the chaos which was going about during the different waves of COVID, and the hospitals are lacking the oxygen for the different patients under intensive care. The next one is for the supply of devices for persons with a disability. Now, under the fifth schedule of the East African Customs Management Act, we have a similar provision whereby if a company or individual is importing such devices, they would be exempt from import duty. And by principle of relation with the VAT Act, even the VAT at importation would be exempted. But with the current bill, they want also to provide a similar exemption for companies dealing in the production or supply of these particular devices locally. So I think this is a welcome reprieve for companies or for NGOs or for any other body whose work is to benefit disabled persons. The next one is a supply of airport user services by the Civil Aviation Authority. We all know that our country is is in a renaissance period as regards our beloved airlines, Uganda Airlines, and on top of that, we do want to increase our traffic in the country. So one of the possible measures that Ministry of Finance has put forward is by exempting airport user services by the Civil Aviation Authority, so that to decrease the cost of using our airports in the country. Secondly, we also know that the Hoima International Airport is going to be up and running in a few years. So one could argue that with this current proposal, it's going to marry the increased traffic in the country and also reduce the cost of usage of the different airports in Uganda. So on to the third schedule, like I mentioned before, second schedule is for the exempt supplies and zero rated supplies for under the third schedule of the VAT Act. Currently, the third schedule provides for zero rated supplies when it comes to educational materials. However, the educational materials which are prescribed are those which are imported into Uganda and are those which are manufactured in Uganda. Okay, so with the current bill, it seeks to basically fall in line with the East African protocol to the protocol to the East African Customs Community, which basically provides for equal taxation of goods moving throughout the community and also harmonizing the different bands of the bands of tax as well. So educational materials which shall be imported from the members of the East African Community shall be subject to zero rate of VAT if this particular bill is passed into law. I did mention something about menstrual cups when I was talking about the exempt, the bills for the exempt supplies and the exempt schedule. And now we can see that it's going to be merged with the supply of sanitary towels, menstrual cups, tampons, and inputs for their manufacture. So that is a brief snapshot of what's going to be what's proposed to be amended under the VAT Act. And now I would wish to proceed to the Excise Duty and the several proposed amendments therein. So most of the audience today, I think, is not not seeing these different items for the first time. We've been referencing them when it comes to the different excisable duties. We've been mentioning them when it comes to your audit. So, but the issue is they've not been defined in the Act, and this has been leaving so much room for ambiguity, so much room for interpretation, and then which is, I mean, it has been causing so many issues for so many taxpayers. Now, fruit juice, and natural spirits and vegetable juice have all been defined, and according to us, this is going to make application of the excise duty and the different rates much easier when there is a uniform interpretation which we can use. Previously, taxpayers and different consultants have been using the dictionary meanings and going online to look for several definitions, but now this has been brought into the Act, which we believe will administer the Excise Duty Act much better. On to the different rates of tax and the different items which have been sought to be amended with the bill at hand. The first is the opaque beer. Now, opaque beer, we are seeing that there's going to be there is a proposed decrease in the taxes. Currently, it is at 30% or 650 shillings, whichever is higher. But with the proposed bill, it's proposed to come to 12% or 150 shillings per liter, whichever is higher. Now, when it comes to unnatural alcoholic spirits, there's been a proposed introduction of a new criterion, okay, for the application of excise duty, and this I'm talking about the alcoholic content, okay. Now, like I said before, first of all, the first proposal is defining the unnatural spirits, and now we are seeing that the bill seeks to bring about another criterion, okay, for taxation of the unnatural spirits, which is alcoholic content. So, in summary, it's divided between locally produced and imported spirits. So when it comes to the locally produced, if the content is greater than 80%, the taxes will be 60% or 1,500 per liter, and if it's less than 80%, it will be 80% or 1,000 per liter. So just like that's basically a snapshot of what's being introduced when it comes to the alcohol content and the different criteria of taxation. Just briefly, when it comes to undenatured spirits manufactured from those raw materials that were subject to the COVID-19 relief, they'll also be subject to no duty, that is the nil duty, if 70% or more is used, if 70% of that material is, if 70% of the content in that spirit is made from those disinfectants or the raw materials which were used in manufacture of those sanitizers and so what have you. Just to proceed, yeah. When it comes to the fruit juice and the vegetable juice, another criterion which has been brought about is the 30% of the juice by weight or volume of the total composition, which is manufactured from the fruits and vegetables locally grown. Currently, it's only 30% of the pulp, which is a criterion, but now this has been also proposed to be increased. Non-alcoholic beverages, the rate seems to be going down to 12% or 150, whichever is higher. And then another interesting proposal is to reintroduce, okay, the tax on sacks and bags and other plastics. This had been repealed in the previous amendment, but now this seems to be coming back at 40% or 4,000 per kilogram, whichever is higher. Something which we had always wondered why Tanzania was not in the list of exempt countries for incoming calls. Tanzania is now proposed to be introduced as part of the exemption for the incoming calls into the country. Another issue comes to fermented beverages. Now, for these beverages, according to us, there had been an error which the Ministry of Finance had passed in the previous amendments. As you can see, the words in red, And then if you look at the proposals, it seeks to realign what the intention was by the Ministry of Finance from the previous year. I think Anki talked about a uniform blanket exemption under the income tax. Surprisingly, this uniform blanket exemption was already available for excise, actually, in the previous amendments. But now what the ministry seeks is to lower the criteria for the investment for $35 million for the foreigners and $5 million for citizens. So that's been that for excise duty, and now let us go through the tax procedures code, which is administrative act for the tax laws in Uganda. Something which is going to affect most of the tax agents in the country. Currently, if you apply for the tax agent license or the tax agent certificate and it's granted to you, it runs for a period of 12 months from the time which it's granted. But with the proposed amendment, the certificate will be valid as up to 31st December. So this means that even if URA approves your registration by November and December is the next month, you will be required by January to reapply for the same certificate. So this is going to help URA to realign their administrative obligations when it comes to tax agents registration and also approval of their certificates of operation. Now, I would like to talk about some penal taxes for the tax stamps. This under 19B of the TPC. Currently, that penal tax only talks about taxpayers who fail to affix stamps, but with the current proposal, taxpayers also fail to activate those stamps. So affixing is not just enough, but also you have to activate the stamp so that the purpose for which it was designed is actually met, which is tracking the movement of that good in and out of the country. So if you fail to activate that stamp, you will be subject to a particular amount of penalty, as can be seen on the screen. And something which is going to go deep, or which is going to hit the heart of most of our clients out there. Currently, in the TPC, there's a section which talks about closure of business in case you fail to meet the tax due. Several taxes due under the different tax heads. But now, if you do fail to comply with the IFRS regulations and also the DTS stamps, okay, URA shall be given the mandate, okay, URA shall be given the mandate to go for. Sorry for that technical interruption. Apologies. So I was still saying, when it comes to the temporary closure of businesses, currently, if you do fail to meet your tax obligations, okay, URA has a mandate of coming to your premises and closing you for a period of 14 days. So with the current proposal, in addition, if you do fail to comply with IFRS regulations, as well as the DTS stamps, okay, URA shall be your enforcement team, okay, shall be given the mandate to come to your premises and look you for a period of 14 days up until when you comply with the different regulations, okay? And again, when it comes to section 33, it does basically talk about the notice of closure when it can be waived. So obviously, if you do comply with the taxes payable, and now also if you do comply with the IFRS and the DTS regulations, then that notice can be waived as and when you're able to comply with what URA has requested for. So when this is a new proposal to be included in the TPC, and it's about our taxpayers and our clients who are in the construction industry. So if you do engage a new contractor, you're required within 7 days, okay, of engaging with the contractor to let URA know of your agreement with the contractor or your contract. And if you do miss this particular deadline, okay, that has been set forth by URA, a penalty of 20 million, okay, shall be levied or assessed against you. So contractors is a very subjective word. It could involve casual laborers. It could involve service providers. So this is one section whereby we shall do some deeper analysis and also do some deeper clarification from the different bodies, and then by the time if it is passed into law, we shall be able to give you a much deeper understanding of the minds of the lawmakers as to why they put this into the law. So false or misleading statements, currently the penalty is just 4 million, but you can see it's being proposed to come to 110 million. So taxpayers out there and other different businesses, URA is seeking to reduce to curtail, to basically bring about harmony in terms of the information that is being submitted to URA. So this is one of those motives, or one of those moves that URA is looking at, reducing fraud and what have you. So the Ministry of Finance is looking at basically reducing all kinds of fraud which are being committed by increasing the penalties for making false or misleading statements. And when it comes to offenses, now you will find that most of these offenses already have penal implications. So some may ask, why are they being made offenses, yet they do have penal implications already. Now, offenses relate to actions which are punishable by conviction. Okay, when it comes to penalties is basically a punishment for a taxpayer not meeting an administrative requirement of a tax law. Okay, so currently, if you fail to with the current proposal, if you fail to affix or activate a stamp, if you print over a stamp and as such you deface it, if you forge a stamp, if you fail to use IFRIS, if you forge an IFRIS invoice, if you interfere with an IFRIS control device, and you will be subject to a particular amount of fine, in addition to 10 prison sentence not exceeding 10 years. So we really suggest that in case any person is out there and they know any business activities are doing this kind of activity, it is worth mentioning that it's not really profitable and it can lead to conviction if this is passed into law. Now, the other penalty which is being brought into the law is to do with the automatic sharing of info between URA and the different bodies around the world. Now, in the previous last year's amendment, Section 88 was amended by bringing to the fact that the minister has the mandate of setting forth the instruments which shall determine how information is to be shared between URA and other tax bodies. Okay, so now and also just to mention is that most of the double tax treaties that Uganda has been able to conclude with other countries under Section 26, Article 26, it does provide for sharing of information. So currently, if URA requests any taxpayer to submit information and the taxpayer fails to submit this information, you will be subject to a particular fine or imprisonment, not exceeding 10 years as well. And then something which none of us like to see in our business when it comes to payment of informers, URA is now streamlined the reward for informers. Currently, it's just a blanket 5% of the tax which has been collected, but now they're trying to break it down. So if the informer just identifies to URA that there's some tax which is to be assessed, shall be given 1% of 18% of the whichever is higher, or the less of 1% of 15 million, or if that informer does help you to recover that tax, it shall be given the less of 5% or 100 million. So let us try to be compliant and avoid these issues of having informers bring about any unwanted scrutiny of our businesses. And that is it for the I think for the main parts of the indirect taxes. So there are some other proposed amendments to some allied laws, and this is a Stamp Duty, TIT Act, and the Uganda Revenue Authority Act. So let me begin with the Tax Appeals Tribunal Act. most of us know that the TIT is having a huge case overload. Okay, so with the current proposal to the TAT Act, the members of the board or the members of the TAT chairmanship is proposed to be increased from 4 to 8 members, and I think this will give more room for objectivity on a number of cases. I mean, we've been seeing some cases whereby about two members of the tribunal agree with the ruling, and the one person does not agree with that particular ruling. So with the increased number of members, we hope to see more objectivity and as well seeing more clearance, an increase in the report of clearance of the different cases before that TIT. And the next law which is proposed to be amended is the Uganda Revenue Authority Act. The bill seeks to amend the first and second schedule. So the first, the second schedule is basically dealing with the board meetings of the URA. So it shall give the Minister of Finance, the powers to basically regulate the board meetings of URA and schedule them as and when it feels necessary. And then Section 11(1), the current bill seeks to replace the word manager with the SC of URA. However, when you look at the Section 11 of the URA Act, we don't see any word manager. And I think it could be one of those gray areas or maybe errors which could have been put in the bills. Luckily, it's not yet the law, so it could be subject to some additional changes as well. The last act I would want to look at is the Stamp Duty Act, and there have been some additions when it comes to stamp duty. You can see them on the screen. We're talking about security bonds or mortgages executed by way of an office. So the number of additional instruments which have come in by the proposed bill, as well as the revising item revising the trust. Okay, so it's just basically widening the scope of the word trust and also bring about some clarity from the previous bill. Sorry, for the current bill, the current act, the way it's stated. So with that brief presentation, I would like to forward you back to our moderator. But once again, thank you for that time. Thank you for the audience, and we hope to have more fruitful discussions in our Q&A session. Thank you very much.
Okay. Thank you very much, Stuart. Thank you very much, Ankit. Where everyone is, I'm sure you are very satisfied with what our presenters have given us. They've given us an insight of what is coming. They've given us how it can affect our business. Some of it might not be extremely broad to your liking, but you've had many of them promising that they're going to go back to the drawing board and interact with the authorities and interact with the Ministry of Finance to see what was at the back of their mind when they were trying, when they were coming up with these laws that they want to pass. And if they are passed, how are they going to be accounted for? How are the taxpayers going to how are they going to affect them and all those things? How will they represent themselves, etc. So thank you very much, Mr. Ankit. Thank you very much, Stuart. That digest was very, very informative. Our clients now, you know what is coming in the next financial year 2022-2023. You've seen what is going to be good. I'm sure those who have rentals, who pay rental incomes, the companies, the individuals especially, you're very happy. You're getting, if it passed into law, you'll have a lower tax rate of 12%. And for those of you who are still being big-headed and you're not taking up IFRS, you're not using the digital tracking system for those who are in manufacturing and you have to put tax stamps, please, 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 you have seen that the offenses that are coming are not going to be very nice. They're going to affect your business very, very much. So some of these amendments are trying to help us recover from the impact of COVID. It impacted our personal lives because many of us lost loved ones and also impacted our businesses. So the government is also trying to help us here. Some of them are positive. Some of them are trying to force us to do the right thing so that we do not have other things that impact our businesses that are going to reduce your cash flow. So please comply with the requirements, especially the ones that are in place right now. IFRS is a very, very big thing right now. If your business is not taking on IFRS, it's not very good for you. Digital stamps are also a very, very big deal right now. So please comply. I can see in our chat box, we have already started the Q&A session. Mr. Neil has been answering some questions of our guests. So we are going to, the next session is going to be the Q&A one, and we are going to have some of you raise up your hands. I think if you look at the top right screen of your corner, there is people chat. There is something that has a little hand raised like this called React. You can click on that and we can give you audience, and you are able to ask us whatever questions you have. Then some of the questions you can, if you are not up to that, you can post in the chat, and Mr. Neil or Mr. Nkit or Stuart will respond to you. So we can now start our Q&A session. I'm going to pass it on to one of my colleagues. He will take us through the Q&A session. So Ankit, please feel free to start our Q&A session so that we can address the different concerns of our guests.
Thank you, Chelsea. So guests, members, to my knowledge, the questions which were posted on the chat box have already been answered. We await the new questions and we will try and answer them to the best of our abilities. Feel free to raise the questions. You could also approach us at tax@ug.gt.com for any clarifications, any requirements for your businesses, and our team would be available to guide you. I am posting the mails on this chat box for the benefit of members.
Rajesh, you can go ahead with your question. I think Nakamya Dorin, you have a question. Please go ahead.
Yes, Dorin.
Hi, this is Robert from MUA.
Hi, Robert. How are you?
I'm all right. How are you?
Good.
I think, first of all, thank you for the presentation. It was quite insightful. My question is on IFRS. So some of us already implemented the IFRS, and it's basically integrating with URA. However, there are very many issues that tend to arise due to IFRS. Either there is a transmission error, credit notes, etc., etc. So we end up having variances in some instances between our own ledgers and URA. How will this be factored in case there is, let's say, an inspection or an audit by URA? Because the penalties are there, will such a thing be factored in? Because some of these issues are not directly derived from us, but it's also an issue with URA itself.
Okay, so Robert, to answer your question, see, while we do agree that yes, there are certain inherent glitches in the IFRS system which taxpayers are facing, credit note being one of the biggest challenge area, Now, these proposals which has mentioned the penalties, these are the penalties for the taxpayers who have been not complying with the laws intentionally. Now, for a taxpayer of like yourself, who has been complying but having the challenges in terms of credit notes, which almost every taxpayer is having in Uganda. So for those, these penalties may not become applicable in that circumstances, or where the reconciliations, there are genuine errors in the reconciliation due to posting of the IFRS invoices, say the months have the lapse in the months, or it has crossed for 1 month in VAT, another month in IFRS system. So all these things are explainable errors or explainable challenges, which might not have the penal or relevant consequences. Obviously, interest consequences can arise as per the situation at hand. So in nutshell, I want to say that it totally depends upon the specific situation at hand. You cannot generalize anything.
All right, thanks.
Do we have any other questions? Okay, sorry about that. I am going to post a link in our chat box in case you want any certificates of attendance, any feedback on this, you want to get access to this presentation so that you can further on share it with your colleagues and everything. I'm going to post a link in the chat box right now. Please go to that link and state your request and we shall get back to you. So we can move on to the questions. The next person who has any question, please feel free to speak.
Can I ask a question, please?
Yes, please. Yes, proceed. You may proceed. Yeah.
Okay. In the past, with the financials, we've had challenges with URA in what exchange rate you use, where we used to use the income rate on the portal, but now because of IFRS, we actually have to use the VAT rate. Will there be any challenges from URA regarding your financials by using the VAT rate in preference to the income rate or vice versa?
So madam, thank you very much for your question. So far as our set of clients or our set of taxpayers are concerned, we have been able to explain the reason for these variances to the respective authorities raising these questions. And we have, in our experience, we have seen that they are giving a proper audience and it's getting resolved. You may approach us with your specific query. We would be happy to help and guide you.
So there is no guidance to say, yes, it's okay to use the VAT rate in your financials rather than income rate, or whichever one is higher or lower. There's no specific guidelines set up by URA at the moment.
Currently, yes.
Ankit.
Yeah.
Thank you very much.
Yeah, Ankit, should we not say that for VAT returns, the VAT rate is used, whereas for the pay as you earn income tax, the income tax rate should be used, because that is what, while there is no specific guidelines, but that's the practice going on.
Yes,
and we recommend using that rate only.
So what happens when you have like, okay, with IFRS, you've got no choice but to use the VAT rate. But say you're in rental income and you're using the IFRS rate, but the law actually says whatever comes first. So if whatever comes first, your income rate is higher than your VAT rate, you're going to have an issue when you file your returns with URA, because they're going to come and tell you that you should use the income rate because your income rate is higher than your VAT rate. And sometimes that does happen. So then again, you've got to monitor how many invoices you've raised in the IFRS. You've got to then work out what the difference is and then file your returns accordingly. Surely that's a challenge, and URA should actually, or maybe you could propose to URA that they should actually streamline that to change the law to say now, because IFRS is there, we should actually use the VAT rate.
But thank you. Your point is very clear. Ankit, can you please note down? We discuss and then we get back to the person who has raised the question, please.
Absolutely.
Lovely. Thank you very much.
Thank you.
Yeah.
Thank you. Yeah.
You can post your email ID on the chat box so that we can come back to you.
Okay. Other question is from, I think, Doreen. She's saying that you are not able to issue a rent security deposit invoice using the IFRS, whereas the other invoices are getting properly effected in the IFRS. Now, any specific reason, or have you been able to approach URA with this set of a challenge that security deposit invoice you were not able to issue through IFRS, and they might have guided you on something, is what I want to understand first.
Okay, Doreen, please unmute your microphone so you can give a response and your question can be properly answered too. Or you can also reply in the chat box so that we can give you a better response. In the meantime, I also see Chiinji Paul has his hand up, so please unmute your microphone and ask your question.
I just want to actually thank the presenters for the good presentation. I want some clarification on the proposal on the rental expenses, where you are claiming the 50% and then you carry the other half in the subsequent year. So if, let's say it's a company and I've claimed all, because if you look at the accounting principles, you claim all your expenses in the year they are incurred. So what will happen if I transfer 50% in the subsequent year? Does it mean that I'm also going to claim the same in that year, or do I in my accounts claim the 50% and then I claim the subsequent one in the subsequent year? I don't know if you have heard me well. Maybe my network is not well. Have you heard my question?
Yes, we have heard you very clearly. We do appreciate where you are coming from. So just to, I don't want to lengthen the response, but sir, you are very well aware how interest capping provisions are working currently. So for interest capping provisions, the interest which is unabsorbed or unutilized or disallowed in current year is clubbed with the interest expense of subsequent year, and that total expense then has to be tested against the eligibility threshold. Right now, as much as this detailed or granular guidance is not available, so what we believe is what will happen is the taxable the total tax allowable expenditure against the rental income would be compared. Any excess would have to be carried forward to next year. Then it gets clubbed with the expenses or the tax allowable expenses of subsequent year. And again, it has to be tested against the rental income of that subsequent year. So this cycle or this circle has to go on and on. Again, this is our understanding of how this amendment might work. Maybe we'll have to again deliberate with the revenue authority or ministry wherever applicable.
Paul, is that a response that is satisfactory at the moment?
Somehow, but as he has promised, I think maybe he will liaise again with URA to see how it's going to work. But at the moment, I think I've got a picture of how I think it will work. Let's just see how, I mean, the implementation is, because at times, yeah. Thank you.
Okay, thank you very much, too, as well. Now, Ankit, Doreen responded saying that she has never consulted URA, but Bimal Patel told me to continue using the old way, but for only security deposits and for the others, he was able to guide me on the use of IFRS. It's because the security deposit has no VAT.
Right. All right. So, Doreen, we are going to get this clarification on your behalf. We will be able to raise it to URA IFRS team and support you in getting the guidance. You may write to us on a specific email. We'll escalate it with the URA IFRS team.
Thank you very much, Ankit. Do we have any more questions? Any more questions that are not yet answered? If you have any more questions, please post in the chat box or raise up your hand and unmute your microphone and speak.
Shamim Tharani has a question. If the income rate against the VAT rate applies to all income, being industry, rental, retail. Maybe the question needs to be elaborated more, because it seems to not I seem to not get the clarity on what is the exact question.
Shamim, can you please phrase the question better so we can be able to give you a proper response, please?
Sorry about that. I was just putting a note on the chat so that when you do finally respond to me, I would like to know whether whatever rules URA apply would apply to any income, not just rental. That means if you're in a sales or manufacturing, it would apply to across the board.
All right, Shamim, we are going to clarify that for you.
Thank you very much. Thank you.
Thank you, Shamim.
Okay, thank you very much. I think most of our questions are done. And we earlier posted our email addresses. There are two. There is one, tax@ug.gt.com, and tax consulting at ug.gt.com. So in case you have any follow-up questions from here, please send us an email on those email addresses and you will get a response to your question. For those, as earlier mentioned, if you want a certificate for attending this webinar, if you want this presentation to be shared with you, any other inquiries, I've also shared the link to which you go and make that request and we shall respond to you. So can we have at least 5 more minutes in case anyone has any more questions? And if not, we can come to the close of the webinar. Okay, I'm guessing that we do not have any more questions, but as earlier stated, there is someone who has just raised their hand now. Juma, please unmute your microphone or post your question on the chat group.
Yeah, thank you for the presentation. I'm inquiring about the IFRS. We have our sales in our books. In our books, they do not match with the IFRS system. And in doing our financials, we are looking at how do we present it. Do we follow the URA? Because at the end of the day, when we are paying the corporate tax, we are considering the sales that we have made for the entire year. So the URA system has a different figure, and we also have a different figure. So how do we go about that?
Juma will have to understand first and foremost why the reason for variance. Okay, and then we can guide you on the way forward. Say supposingly we don't know which what operations do you operate under. Let's say there is some entry which has been posted for provision of a rental income. Now for that one, that entry has been posted in books of accounts, but it will not have impact in VAT and therefore not in the IFRS, because it is something which is merely an accounting entry which has been done to comply with IFRS or the GAAP. Now, if in your case, we need to specifically understand why, first of all, the difference, and then guide you.
Thank you. If I have understood Juma's question, maybe Juma is saying that IFRS has started from part of the year, okay, and they follow the particular accounting year. So from the part of the year, the IFRS begin, and therefore the sales as per the URS record will definitely have been less than the books. So it is because of the period that URA has begun from, and the company, Juma's company, follows. So that is explainable in my opinion.
Yeah,
because it doesn't have to match.
Yeah, then it does not match and it is explainable.
Okay, thank you very much, Ankit. Thank you everyone who has given us your time to attend this webinar. We really appreciate the nearly 1.5 hours that you have set aside and respected the invite that we shared out with all of you. I want to give special thanks to our managing partner, Mr. Anil Patel, along with his supporting partners, Mr. Jasmine Shah, Mr. Uday, Mr. Nilesh, who are also present in this webinar. Thank you very much for giving us all the resources that we have needed to prepare this presentation for our different clients and prospective clients. Mr. Ankit, Mr. Stewart, thank you very much for setting aside the time amidst all the other work you have, for putting this as a priority right now, because it's going to affect a lot of our clients in a positive and a negative manner. And with the different proposed amendments, there will be some which will be good, some will probably not be, you'll not be very happy with the impact they'll have on your business, but we will have to comply. As I've seen in the Q&A session, we had so many questions on IFRS. It being a new system that has just been implemented, there are so many things that need consultation on. So please get to us and we shall support you. You will have a discussion with our team and they will be able to guide you. And you can also go to URA for further clarification. So our doors are always welcome. Our offices are at Lugogo 1, which is opposite Tata, Uganda. Feel free to visit and have a conversation with our consultants and they'll give you guidance. Also feel free to respond on those emails. You will immediately get feedback. And I want to also keep thanking you for, again, thank you for the time that you've given us. Continue to be safe. We might have had lesser cases now. We're out of lockdown and everything, and operations are back to normal, but COVID is still present in the country. So please continue to keep safe, wear your mask, hydrate, do everything you have to do, sanitize, clean your environment, social distance, and let us keep building this country together. So thank you very much. Thank you all for giving us your time. Thank you for attending your webinar. I would like to officially close off this webinar presentation. Thank you.